May 19, 2009. Thank you everyone for joining me on the Endless Mountain Network. So, has the stock market bottomed? And is the economy recovering? I will do the absolute best that I can to answer those questions. So, has the stock market bottomed? I don't know. Maybe it has. We are seeing the stock market rally pretty nicely, and you can be saying, well, aren't you saying that everything's going to collapse and crash? Well, the answer to the second question about the economy recovering is no way it hasn't. The unemployment rates are going a lot higher, and we're going through this change in consciousness that has been predicted for so many years. So no, the economy is not recovering. But just because the stock market goes up doesn't mean the economy recovers right now. I've been looking at a lot of charts lately, and what I've been noticing is that the dollar does the opposite of stocks, and it has actually for a while now. So I'm keeping an eye on this. So what this means is, so we're seeing a lot of signs that the dollar is going to collapse. Anyone who's been watching the US dollar index is understanding, well, it's going to go way down. People are seeing a bond bubble, wanting to short TLT because they see bonds going way down, which looks very true, like it's going to happen. However, if the bonds go way down and the US dollar goes way down, would the stock market go way down? And the answer is no. The reason why the stock market would go higher is because they keep printing money. And with that printed money, they are using it to save the banks, to save these companies, and they're putting that money into the system. So that is why the stock market may not be bottoming. That's the best way in which I can explain it, but that doesn't save the economy because they're just printing up this money, this fiat money from a printing press, and it's not even a printing press anymore. They just type a bunch of numbers in the computer and push an enter button and maybe throw a PIN number and password. I don't know. That is how money is being created. So sure, we might have seen the stock market bottom in March, and maybe we haven't, but nonetheless, if it has bottomed and we see the stock market going to 11,000, 12,000, 13,000 and so on, that just means inflation is coming into play. The Zimbabwe stock market went way high because of all the money that they printed. And that should happen the same thing here. So if you see the Dow Jones at 20,000, and you may within the next 18 months, that's an area for concern. It's a massive area for concern because that just shows you how much loaf of bread really is. George Fertitle just did a video recently about the prices at a discounted supermarket in California and how those prices are going really high. Folks, it looks like inflation period is starting. I came on here talking about how we are in a deflationary depression. I'm going to be doing a video soon about moving into this inflationary depression because it looks like the transition is really starting to happen now. I was kind of thinking, and maybe it still happens, like there's one more big washout in the stock market. What that would mean is another wave of selling, bringing the Dow Jones, which was 6,400, down to 5,000, 4,000. And like I said, that could still happen, but it doesn't mean that it is going to happen. So if you're looking for a bull market, there is two different categories in which I look for on a bull market, and as long as both of them are into play, that means that I will consider possibly a bull market. First one is the 200-day moving average. It has got to flatten out and start to increase, and you can even make a case for even a 250-day moving average. Either way, the 200-day moving average has to flatten out, start to increase. That is a bull market. The moving average has been decreasing. It has been decreasing since January, I think, of 2008. So that's when the bear market would have officially started, if you will. And it's still been decreasing ever since then. Now, even though, like I'm saying, even if it flattens out and starts to rise, that could just mean that we are starting to see stocks going higher because of inflated money. So you'd almost have to take a look at a Dow or an S&P inflation adjusted chart, because That's when we truly get out of this period, is when the 200-day moving average inflation adjusted stock market flattens out and starts to increase. That's when we will have a true bull market in the stock market. So what I did is I've also made some charts, and I'm going to put them on over the next few seconds here. And what these charts are is a year-over-year type of stocks. Basically what I did is I took my spreadsheet program and I took the last 250 days and I took the price of what it was today compared to 250 days ago, as that's the average amount of trading days in a year. Now, today is May 19th, 2009. May 19th of 2008 was a big day last year because that's when the Dow Jones topped at around 13,150. Yeah, 13,150. So now we're down to about 8,500. And of course, that just means we're down quite a bit. So all these rallies are still just bear market rallies, and they can be violent. The more violent the bear market is, the more violent the bull market rallies are, and that's why this rally has been very violent. Anyway, so what I'm going to do is I'm going to go to these charts now. We're going to look at some charts at the Dow Jones, and this is going to be percentage changes, sort of looking like a MACD histogram. And what this is the percentage the Dow Jones is up or down since 250 days ago. I'm using 250 days because it is about a year's time. There is approximately 250 trading days a year. So this is from 2001 to today. This is a daily term time frame. And we had the bear market at the start, the NASDAQ bubble right over here. Don't know why it did that. Let me just fix it. There we go. This is the NASDAQ crash here. This is their so-called recovery, and this is the current crash now. We have had lower lows as these lows have been taken out. So people are saying that it's time to buy stocks and this is a bull market. Yet there is no reason to be buying stocks for the long term until the 200-day moving average is flattened out, and we can at least see that this is now in positive territory. Last year, the Dow Jones was 13,150 at May the 19th, 2008, and people were saying a summer recovery was going to happen. They're saying the same thing now. So there's no reason based on this chart to believe that things are going to get better. Now, this is from 2001. This is from 2007 on. Same deal. 250 days ago. This top here was from July of 2007. So this happened before the October crash. And I don't know if head and shoulders patterns means anything to this type of chart, but a clear head and shoulders pattern, and this thing did sink really vigorously. In the January and February of 2008, it was battling between a small loss and a small gain year over year. And then, of course, it was just off to the races for selling as we've seen this thing go lower and lower and lower. That shows weakness, and pulling back up so that it's only a 20-30% loss year over year. Well, that is not a surprise for the stock market in general. This is a 3 year over. This is 3 years over 3 years. So what the market was like 3 years ago, people are losing because this is from the 1929 crash on. So you see these massive gains of over 200%. Well, when the Dow Jones, which was like 300 and almost 400, goes down to 40 and then triples to like 120, that doesn't say much really for a 200% gain. And you could be saying, Derek, well, look at all these stocks. I mean, I don't see why stock markets are designed to lose. Look at the majority of it on the upside compared to it on the downside. And you can say, well, nominally you are right, but there's a thing called inflation. This is the same chart, inflation adjusted, and we have a lot more on the lower side. Look at this bottom part here. This one is very key. Notice how we have a down trough, comes up for a little bit smaller, and then yet another down trough. Well, here we have the down trough, an up trough, and a down trough. That's showing you the difference as far as what inflation is all about. final chart. This is how much the Dow Jones is worth compared to what it was like before the crash, which is it's August of 1929, inflation adjusted. So yes, the Dow Jones was 380 at this point. So you can say, well, aren't we up big time since then? Nominally, we are, but what you bought for $380 in 1929 will get you nothing close to what it will today. And it took a long time for the crash for people to even see positive inflation adjusted. I mean, this here is 1959. It really took till the 60s for people to get their money back. We had the 70s fall, the recovery, and now we're having the start of another fall. So basically, we are just starting this fall right now. You see we have this down, the up trough, the down, the up trough, and now we're starting the down trough. We're like right here. So we might pull back up like we see here. That is not a surprise. So the pull up to about here and then fall down lower. This is the potential for something that could happen. And the key thing here, though, is shadow stats, meaning inflation adjusted. If I was, like I was saying before about the stock market going way higher because of inflation, you're going to want to take a look at what the shadow stats says here. Also, if you have the shadow stats data that is recent, I am in the need of new shadow stats data. If you have an account, please message me, as I am in the need of current data. This data is from August 2008. Thank you very much for watching this video, and have yourself a magnificent day.